Before we start, we would like to thank Nasdaq, sponsor of this episode.
Nasdaq is the leading global exchange supporting companies from all over the world as they transition into the U.S. capital markets with leading IR services and unique access to both U.S. and global investors. Welcome to Investors and Relations, the podcast in Hebrew. We call it משקיעים בקשר, that actually puts together the intersections between investor relations, capital markets, and the people that make investment decisions. So, Rami.
Yes, Daphna. I'm a little bit confused here.
Right, we're not in our
Because we
usual
switched locations.
locations and also the directions.
Exactly. And
Right.
I'm keep looking for your nose earring, and now I see it. Very nice, as usual.
Thank you.
So today, Daphna,
Yes.
we are joined by Tal Liani, Managing Director at Bank of America, Head of the Technology Research Super Sector. For nearly 3 decades, Tal has been one of Wall Street's most influential voices, covering technology companies and helping investors understand some of the biggest shifts in software, cybersecurity, and networking. Since joining Bank of America in 1998, previously Merrill Lynch, Tal has consistently ranked among Wall Street top technology analysts, earning more than 20 consecutive years of top 3 rankings in the Institutional Investors All-America Research Survey. Is that you? That's really you?
Thank you for having me, and my mom would be very proud of your introduction.
Okay.
So, what's special about Tal, besides all the rankings and being really like one of the most well-known names in Wall Street, is the fact, Tal, that you're still excited about research to this day, right? Even 30 years later.
Absolutely. This is one profession that you don't have 2 days that are the same. Every day you wake up in the morning and something blows off, something goes wrong somewhere.
All right.
And you have to respond, and you have to basically guide investors with what to do with a new piece of news.
So that's always exciting. And I think that before we start, we just want to give our usual disclaimer that the entire information that you guys are going to hear about in this podcast
Guys and ladies.
Yes, thank you. Thank you, Daphna. Is purely educational purposes and entertainment purposes. Both of us are not financial advisors, and any action taken following the information brought in this podcast is done on your own sole responsibility. With that, Daphna.
So Tal, actually, I like reading your LinkedIn posts. And in one of them, I think it was a pretty recent one, you said, you sort of compared and said how different it is, and actually relates to what you just said now. Musicians to sell-side analysts. And you gave the example of Hotel California. Okay, you can live off one song forever. And then you said analysts or equity, research, sell-side, there's all kinds of different names for the profession. One day is different than another. So you touched it briefly, if you want to.
So, I've been doing this for almost 30 years, more than 30 years, actually. If you count also my experience in Israel, it's more than 30 years. And whatever I said last year has zero value. Maybe it's value to me because I'm gaining knowledge, but it has zero value. No one comes back to me today and says, in 1998, you said something very important. It doesn't work this way. So because of that, I have to reinvent myself every quarter. And I want to give an example. We had an unfortunate event in 3 years ago that my brother died in a car accident, in a motorcycle accident. And that year, I almost lost my ranking because I was out of commission. I was not able to focus for a few months. My research was not as good. I wasn't focused. And immediately I lost the ranking. That year I went down to number 5 in the institutional investor ranking, which was the lowest in my career, my 30-year career. The following year, I focused. I went back. By the way, it was very telling about Wall Street to see the reaction of my managers to my decline in ranking, but that's a different story. Focused on it, published again, top of the game, and I went back to number 1. And that shows you how how much focus you have to have all the time on your real, like the definition of my job, which is to tell investors what to do with the new piece of news, or to tell investors what to do for the next 3 years and 2 years. So I wish I was able to be like the Eagles, to publish one song, Hotel California, and that's it, and live off it for 30 years. Unfortunately, I don't have 3 months even.
But you still love it.
I love it. It doesn't matter. I would have not been able to work in a factory like Charlie Chaplin and close the whatever for every single day for the same thing for 30 years. Here, if you think about what I'm doing day to day, sometimes I learn new companies, sometimes I learn new technologies. I always evolve. It's the nature of it's not me. Every analyst is doing it. It's the nature of the beast. You have to evolve with the technologies. For example, 20 years ago, 30 years ago, I spoke about broadband, and I was part of this .com bubble. I was an analyst during .com bubble. Then I spoke about internet and the way that internet changes business models. Today, I'm talking about AI. So the industry changes, the technologies changes, companies change, companies become bigger, companies become smaller. You have to react, but react is a bad way to do it. You basically have to forecast and understand what's coming, what's the next step, and be ahead of the game so that you add value. Because if I only react, I'm a journalist. I don't want to be a journalist. I want to be an analyst.
And in a way, it reminds of investor relations, the profession of investor relations. And when you move more from one company to another, or even the involvement of a company, also, and that's, for example, why I really love my profession.
Maybe it's like the other side of Tal's work, because he writes about things that we are experiencing in the day-to-day work of, inside the company.
So I always tell investor relations this thing. I did tens, if not hundreds of IPOs. And I tell in the investor relations this thing: you date the banker, but you're going to marry me. So,
right.
So let's work together, because at the end of the day, from the point of going public onward, it's you and I. The bankers are behind.
That's the reel of the episode.
Yeah. And it also, it's so nice to see how every, episode and people that are different people that come to our podcast, that things come together. It reminds me of what Chaim Friedland from Gornitsky said about exactly that. The IPO is the wedding, but then you have the marriage. The being public is the marriage.
Right.
So.
Okay. I'm not going to sing Hotel California.
You also don't want me to sing Hotel California. Trust me. I was the only kid that wasn't accepted to the chorus.
I'll take your word for it.
I was the only kid that wasn't accepted to the chorus in school.
Wow.
Only.
Okay.
Yeah.
I was the singer of my high school.
Really?
Yes.
Singalovsky.
It's actually not the high school, the elementary school. It's Sadeh.
Nice. Tal, when you started, like, as you said, 30 years ago or so, the analyst was almost the sole source, the primary source for information for investors.
Yeah.
Today, corporate access is much more available for investors. Data platforms have tons of information, AI, etc. At the end of the day, there are thousands of analysts in Wall Street, 5,000, maybe more, I don't know. What makes one analyst stand out from the crowd?
If I have to synthesize it to a single example, I'll tell you that my job is the job of the little kid that stands in line and says, hey, the emperor has no clothes. Because at the end of the day, it's very easy to repeat what management feeds you. But remember that management team, and it's not bad. I mean, that's the way the world is working. Management team has an agenda. They're optimistic. They have their own plans and their own strategy, but I'm an outside person. I don't feed investors with what management is trying to feed me. I have to take it as one source of information, take maybe AI information as another source, that's the new thing, but then bring my own judgment and basically analyze it and say, yes, this is what is going to happen in my view. It's all views. We're not talking about exact science. this is what I think will happen, or I think that what management is trying to do will not work. At the end of the day, no one is paying me, quote unquote, paying me. No one is paying me. No one is using me. No one is reading my research in order to hear what management is saying. What defines me, being an Israeli, being a foreigner in the US, I'm foreigner. 30 years there, I'm still having the mentality of a foreigner. Being a foreigner, being the person that always tries to prove himself. What defines me is my ability to stay independent and tell investors exactly what I think. And sometimes I work with companies. Sometimes my message is contradicting what management is saying. But at the end of the day, that's why I'm ranked high for many years, because investors, when they talk to me, they know that they'll get the real thing, that they'll get my real views. By the way, it doesn't mean I'm always right, but I will always have a very defined view and very reasonable, rational view. I'll always support it with points. I'll always support it with data. I will always have something that I can defend. And that's the whole point. And sometimes investors agree with me, sometimes they don't, but they will hear a very opinionated and defined view. That's the whole point.
Were there cases that you knew? I don't know, maybe you don't want to give general examples, or I don't know how specific you can be, that you went against the stream?
Yeah.
Okay, not a specific company, but I'd say against the general, I'd say, view of Wall Street or other analysts, and you knew you were right. And what made you know it, that, when you identified that you were right and they were
right. So it's easy to go back to .com bubble just because I can mention easily company names and names of companies that don't exist anymore, etc. I remember roughly year 2001. I'm a new analyst on Wall Street. I was in London covering Israeli tech. Then I moved to New York to cover telecom equipment, American companies. And I look at the companies and I say, sell, sell, sell. That was at the time that no one had given sell ratings. And one of the bankers, I presented it, and one of the bankers said, oh boy, this is a very wrong way to have a career here and not getting fired. And eventually when I was right, when the stocks came down and the market collapsed, etc. And for me, I looked at it in a very academic way almost. I said, these business models don't hold water. These business models cannot work for the long run. These companies will never make profits. When it worked, I gained basically that's how I became a senior, because I gained my trust with investors that I will always say the right thing, what I think is the right thing, right? There are always conflicts with management teams, because everyone likes me when I have a buy rating and everyone hates me when I have a sell rating. At the end of the day, the person in front of me is either the CEO or the CFO or any of the C-level executives. They have tons of stock in their underlying company. When I say something wrong and if I'm right, when I say something negative and if I'm right and the stock goes down, or they're afraid that the stock would go down, it will personally hurt them. So the interests are not aligned to begin with. It doesn't matter if I have a buy or a sell. The interests are not aligned. And that's why I have to keep my independence.
Do you tend to speak more like to IROs, like the IR people internally, or what do you think? And, we know what we think about IR. I'd like to hear what you think.
Investor relation people are way more objective than executives. And I will divide up the world into two parts. Some investor relations, and that's more the old days, are high-level administrators, meaning when you have a question, they'll tell you, let me find someone to talk to you. Some investor relation people are very opinionated, knowledgeable, and for me, it's much easier for me to talk to them than to talk to management. First, they're more available. Second, I find them to be extremely honest and rational. We can disagree, but the discussion is never covered with personal interest in the stock. They want to do the right thing. Third, they've heard their management team saying the same thing to 1,000 investors. They can synthesize for me what the senior management said to other investors. And when I talk to them, one conversation will basically summarize whatever management team had said for the last 3 months. So for me, talking to investor relations is so important because it's just a very efficient way of spending my time. Of course, I always want to talk to management because at the end of the day, management team comes with, they know the business in and out. They talk to customers. Their level of knowledge always is naturally higher than the investor relations. But if I speak in percentage, I would say 90 to 95% of my needs could be covered by investor relations. And most of the time it's great. It's more than enough. When I need the extra, or when I want to host someone with investors, maybe then I'll approach C-level executives just because I know I can ask one level up. What I've done in the last 2 years is something we call Summer Friday, where I host I value investor relationship. I value the relationship with investor relations because I think that they're extremely knowledgeable. What I do is I do Summer Friday when I host investor relations for 1 hour discussion about the company. And I find
with investors?
With investors, right. And I have between 100 to 300, 400 investors every time.
Wow.
These are big institutions, etc. And I find it extremely valuable because at the end of the day, most of the investor relations understand Wall Street more than executives.
Their job.
It's their job. They are in touch with investors all the time. As a result, the discussion is like ping pong, meaning I ask a question, I get an answer. I ask a question. It's very efficient use of my time, very efficient use of investors' time, very efficient use of management time for the companies. It's like win-win for everyone.
Win-win.
Right. And we've done it for 2 years now, more than 2 years. The reception is extremely good.
So that's instead of having the C-level attend,
It's always right. Always on top. Like when I have an opportunity to host a conversation with C-level executive, I will always use the opportunity, but it serves a different purpose.
Yeah.
Sometimes I tell you when I use C-level executive versus IR. Most of the times, nothing happens in the companies, meaning you have the natural evolution of the quarter, certain things happen, management said a few things, you need to understand what they're saying. Investor relations is perfect at delivering the message, explaining the message, broadcasting the message to investors. I don't need to wait for the 20 minutes that the CEO can give me. But sometimes something is fundamentally different. And either big piece of news, good or bad, or that the quarter was really, really bad to the point that it needs explanation from senior management. At that point, I will try to host senior management. But the problem is availability. At the end of the day, senior managers don't work for Tal Liani. To get access to their time, to their calendar, sometimes I can wait 3 to 4 months. But investor relations, I can tell you that I can get a discussion with investor relations within a week time frame. Any investor relations, any company, anytime. That's their job.
Interesting.
It reminds me actually also of a case like in around, I think it was the end of 2007 to the beginning of 2008. I was the IRO of NICE at the time, VP IRO of NICE. And I attended a conference, and it was with the whole financial crisis with the financial institutions, the banks and everything. And I remember I told the CEO at the time, it was Chaim Shani, I told him, listen, it's a time when they need to see you in the eye, not me, not even the CFO. And we really did like an express sort of NDR. So I can...
Yeah. So some managers understand the importance of investor relations. Some managers don't.
Yeah.
And at the end of the day, forget the CEOs. CEOs are busy managing the company. Let's talk about CFOs, because CFOs are, part of their job is to do investor relations, so to be in charge of investor relations. Some of them understand the role of IR, some of them don't. And the issue is they don't understand at the end of the day that it's the sensitivity of timing, the sensitivity of explaining things to investors when times are tough or when times are great. I always, it's very easy to speak about times are tough because that's when I need you to pick up my phone. But it also, when times are great, you want to explain it, because at the end of the day, you want to translate what the company is doing. You want to translate it to investors, and you want to translate the long-term meaning of it, not just the short-term, we beat the numbers by 2%. I've been working with a lot of investor relations, all types of investor relations, all levels of investor relations. And in the last few years, you've seen analysts that are becoming like people like myself that are becoming investor relations, just because this role is so important that you need someone maybe that had either done it for a few years or someone that crossed the line from being a sell-side analyst to investor relations, because at the end of the day, I am the pipe to investors. Investor relations is the pipe to me and to investors. And the information flow goes from C-level executives to investor relations, to sell-side research, to buy-side research, to investment community. That's the way it should work. Some companies understand it, but some companies don't.
I want to talk about credibility.
Yeah.
Okay. It's, you can spend a lot of time, years, quarters building up credibility, but then you can lose it
Right.
quickly. What happens? When did you see like a case of losing, and how does it happen? When you saw, like, in general.
Okay. I'll expand the question.
Okay.
I think, categorically speaking, CEOs, CFOs are not independent. Investor relations are independent. And I'll explain what I mean. I know they work for the company, but at the end of the day, they don't want to lose their own credibility. CEOs and CFOs, they have to report to the board. They have to report to investors. They have to report to customers. They have to report to their own employees. They will tell me what they think I should hear. That's not the case with investor relationship. Investor relations will tell me, will try to, even if they have to work by their guidelines, they will try to interpret what management is saying and try to fit it to reality. The problem I have with some managers are so straightforward, it's easy to work with them. They'll tell you, these are the good things, these are the bad things, and they'll explain me the bad things. Some managers will always be so positive to the point that I cannot even use what they're saying. I don't trust a word of what they say. And then I have to find another source of information. So either I find another C-level executive that I built a relationship with and I know that they'll tell me things the way they are, or that I speak to investor relations. Because with them, I find that they understand, they're in touch with me all the time, and they understand that they cannot lose their credibility, because otherwise, the worst thing that can happen to investor relation is that if I really don't trust management and I don't trust investor relations, I'll come up with my own explanations and I'll be dead wrong. It's my problem, but it's also their problem.
Of course.
Because it means that they didn't do their job properly.
You're part of the pipe.
Right. So they need to make sure that I always have the right information. Sometimes it's about the numbers. Sometimes there is a consensus of numbers and their job is to make sure that I'm within the range. Sometimes it's not in the numbers, it's the views. Something new happening. An example? What's the impact of AI on your company? What's the negative impact? What's the positive impact? I may not know the answer. Their job is to basically sit down with me and explain me what is the impact. So then I can take it and do my own research. Give me the first step. I'll make the next 9 steps, but give me the first step to guide me in the right direction so I don't waste time on going the wrong way, basically.
So, in a way, if you can maybe elaborate on how this is done exactly. Meaning, the CFO, CEO, also the IR, they have a certain line of messaging that they need to communicate. Sometimes it involves a lot of financial cliches or companies jargon, companies cliches, etc. And you hear it, and obviously you want to kind of break down these cliches into actual information. So after you hear what the CFO is saying, then you sit down with the IRO and he gives you another kind of information, or is it
right?
I'll
give you a specific example. One of my companies changed the way that they do service contracts. Mm-hmm. And they changed the way that they basically they gave incentives to customers to sign 3-year contracts, service contracts. When you sign a service contract and you sell hardware with it, so that's in the space of networking that I cover. When you sell hardware and you have a service contract, you can recognize the contract 62% upfront. Instead of 3-year contract, 62% upfront. Yeah. Second year, you have overages, you can recognize the overages 72% upfront. What happens is that suddenly your software revenues jump 30%. But nothing happened. Fundamentally, nothing happened.
Mhm.
But you recognize upfront, 1 year 62, second year 72%. The bad thing is that the third year, you have only the residual left. So if you're a good analyst and you understand it, you sit down with management and you tell them, hold on, this great growth that you highlighted on the conference call, is not because of fundamental change. It's just because of the way you account, you do revenue recognition. So in this case, I sat down with management team and the management told me, no, we can refill the numbers. And they gave me the answer that I didn't want to hear because they didn't address the elephant in the room. And the elephant in the room was that you grew 30%, not because of real thing. You grew 30% because you recognize upfront revenues. I sat down with the IR, I explained everything, and I said, I need to know how much of this growth was related to this revenue recognition versus, and then I was able to break it down, bring it to normalized levels, and I had a sell rating on the stock because I said, it will be another year. Maybe I'm going to be wrong for 3-4 quarters, but eventually you'll deal with year 3. And year 3 is very little growth. So did it ruin my relationship with the executives, the management team? Maybe, but it's my job. I don't care. I'm running marathons. I'm not running sprints. I'm covering these stocks for 30 years.
Mhm.
1 year I'm going to be right. 1 year I'm going to be wrong. I have to do the right job. I have to do the job of an analyst and break down the numbers and understand what's driving the company. But the IR was smart enough to keep the relationship at extremely professional level, although she was very disappointed with my sell rating, etc. But to keep and keep feeding me with information all the time. And eventually, one day I'll turn it up to a buy when it's the right time. But for now, this is what's driving
If
the
they
growth
really
rate.
filled up the
Right, exactly.
And the change of rating obviously is an event, which is very important.
It is happening now with AI, by the way. Same thing. AI, I cover now software.
Mhm.
And AI, you can divide up software again into 2 big buckets. Companies that create platforms and they're being helped by AI because you need to implement AI, you need a platform, software platform for it, or companies that have applications. And the risk there is that AI will replace you. Categorically, I'm not talking about one company or another, categorically, application companies are being hurt or being at the risk of being replaced by the AI, and platform companies are being helped by AI. So tailwind and headwind. Categorically, the application companies today are telling investors AI is a big win for us. We're going to be helped by AI. And my job is to basically sit down and say, this company, yes, and this company,
like
no.
specifically.
All the companies, no difference. All the companies tell me that AI will help them to grow. And I know with my own experience that when disruption happens, back then the disruption of broadband and the disruption of Netflix versus Blockbuster and the discussion of Amazon, the disruption of Amazon versus others, when disruption happens, there are winners and losers. You cannot have a situation that it's a win-win for everyone. There are winners and losers. So with AI today, I'm very careful with my software coverage to try to identify the winners, and equally important, to try to identify the losers. And management team will never sit down with you and tell you, I'm a loser. That's not going to happen. It's up to you.
Most of them will be losers.
Yeah.
I mean, the
Smaller,
approach.
So smaller companies that provide applications, specific point applications, categorically will be losers. Small companies. Large companies, it depends on how entrenched they are into the workflow. It is extremely difficult for an enterprise to change workflow with AI, without AI. If you work in a certain way,
The bigger the ship.
right? If you work in a certain way, big enterprise, work in a certain way, and you have 20 places where this software is embedded into your workflow, impossible to replace it. So there are winners and losers. The large companies, some of them could be replaced, some of them not. And that's where my research comes to try and identify one way or another.
Did you identify, as you say, like relatively small point app solution that will benefit from AI?
Yes. but it's not a small app solution. Some companies are not related to AI. If, for example, this is not a real company, but if, for example, you design software for just architects. I'm just making up an example, just architects. And you are very well entrenched into the systems that are city systems, city planning of where the sewage is and where the water is. And you have all this data that is impossible to replicate. And you have it in your system. And when you design the software, you take into account all this design below that. That's such a niche player or such a niche market that it's impossible to replace. AI cannot replace you. AI is a tool. AI is not a platform. AI, at the end of the day, is a tool that helps you to make things more efficient. The winners will be companies that are very well integrated into the data, and they have proprietary data that cannot be replicated by AI. Remember that AI works when you have tons of information that repeatable. An example, you try to change a password. You've done it 100,000 times in the past. You've done it for the past 20 years. You've done it so many times. You have data how to do it. AI can help you to do it automatically. So that's a case that AI can easily replace people. Reset password. But there are cases that you don't have a lot of information. You've never done it in the past. You've done it multiple times. You don't have good record of it. What will AI do? AI doesn't work in a vacuum. It needs historical data in order to live off it. So those unique cases of software companies that have proprietary data, etc., these companies can work and strive and grow with AI because they'll use AI to enhance their system. It's not going to replace their system. And that's the whole, you need to find within software coverage, you need to find those companies that could be replaced versus companies that could utilize AI as a tailwind, meaning to grow of it.
Let's take AI and talk about analysts.
Yeah.
Okay. How do you think it's going to impact your profession?
Okay. My job is not to write a report. My job is not to do Excel. My job is not to summarize news for you. My job is to use all of what I said to give you an opinion. I'm not hallucinating. I never hallucinate, meaning I have a very strong opinion, unlike AI. And there are parts of my job. I'm a platform. I'm not an application. I'm a platform because there are a lot of sources of information. And at the end of the day, there are my opinions. And the same way that you look at the market today, I cover Cisco. I cover Microsoft. There are 150 people covering Microsoft. What makes a good analyst of a bad analyst? A bad analyst will take what management is saying and will regurgitate it. We'll say it again in different words. A good analyst will take what management is saying on Microsoft, will take what he or she thinks about Microsoft, will take all the data that we have behind it, will do independent research with the competitors of Microsoft, will do independent research with the AI application companies, with hyperscalers, and then synthesize everything and tell you, this is my view about how the next 3 years are going to be. I think that AI can help me do my job way more efficient. I think that AI can help me do my Excels in a heartbeat. I'm trying now, for example, to use AI to give me the Excel spreadsheet within 30 seconds when a company reports. That's a great tool. But AI cannot replace my ability to come up with a firm opinion on the stock based on all this kind of data that I subjectively come up with. It's not an objective profession. It's a very subjective one.
So if maybe follow up Daphna's question, the evolution of the sell-side analyst role will be higher quality research. Because as you said, they are approaching different sources of information. They're doing different sub-research, this and researching that. At the end of the day, everyone will be an opinionated analyst, he or she. But will it reduce the number of analysts covering Microsoft? You said 150. Who has time to read as an investor to read 150 notes?
Right.
And everyone has
Works
their
for
own
one company.
opinion, and everyone thinks that their opinion is the most unique one, etc.
Right. I think that you have to look at things, first of all, in a broader way. Startup companies are using sell-side analysts in order to go public. Investors are using sell-side analysts in order to evaluate the startup companies when they go public. That part is case-by-case basis. Every time I learn a new startup, every time I learn a new company, I am exposed to a new world. Some companies overlap, you have some industries you work at, but my job is not just about public companies. I work with VCs to understand their portfolio because they teach me about where the market is going. I work with startup companies, helping them and helping investors basically to get exposure to the right startup companies. And I work with investors about public companies. Parts of my job will be automated. And you ask me about AI, but I want to take you 10 years back. I was able to work with Irevna in India, offload all my maintenance work to India outsourcing companies. And still, 10 years after, I still have associates. It never replaced the role of an analyst, although it was a system that is very close to AI. You send the press release, you get an Excel sheet back. It was just done in 3 days, not in 30 seconds, but it's the functionality of outsourcing and increasing efficiency was there. And still, I have the same number of associates that work with me. So the way I look at it is the role of an analyst as a source of information is, let me define it in a different way. I am a walk-in encyclopedia. I only cover 25 stocks. These 25 stocks, I know the history of when they wrote the book 30, 40 years ago. I've been following them for the last 30 years. I know all the up cycles and down cycles. I have an understanding of a full cycle, meaning from up to down to up.
Yeah.
That parts of it can be replicated with automation tools such as AI, but all this knowledge at the end of the day is helping me to be a better analyst. So you're talking about 150 150 maybe analysts that cover a big company like Microsoft or Cisco, but at the end of the day, there are 10 that are the best. And investors will utilize these 10 more than the others. Why are the other 140 exist? For their own business models. These companies have their own business models, but at the end of the day, every stock has a few big leading analysts that know the history and can give you pretty good analysis of the future and can have an opinion. And that's why you have leaders and you have people who are
You touched different sources of information, but many
Yeah.
times also we see like in the report, channel checks. My
Yep.
channel checks are that. If you could
Yeah.
explain what
Yeah,
channel
yeah,
checks
yeah.
means.
I hate this word, channel checks. So first let's explain and then I'll tell you my view on it because I'm a very big advocate against using it. Channel checks is the ability to talk to distributors and resellers during the quarter and understand and guess, I'm going to use the quotes, guess how the quarter will look like before the company reports results. There's nothing illegal in it. I'm calling distributors that are not public companies and I'm telling them, what do you see in the market? And they tell you, I am below my target for this quarter. I am above my target for this quarter. Okay. So that's the whole purpose. And the purpose is coming because hedge funds want to have an edge, a legal edge, or in a legal way, an edge before companies report, and they want to understand where the market is going. So I understand why there is a need for some channel checks. Now, reality. If you take, I cover Palo Alto Networks. They have 70,000 resellers. In a good day, I can call 5. In a good day. My sample size will never be accurate.
Yeah.
Even if all the 5 people answered me correctly, and they honestly they gave me the right answer, I'm going to be so wrong in the grand scheme of things just because my sample size is not repeated. Now, not only that, who do I have access to? let's not kid ourselves. I have access to the smallest distributors on the planet because the big ones will never talk to me.
Yeah.
Those that represent 20% of the revenues or 40% of the revenues, and there are two of them that are 40% of the revenues together, will never talk to me. So through the years, I realized that these channel checks are so inaccurate that they're misleading more than they lead me. And I told investors, whenever someone calls me before the quarter and say, what did your channel checks say? I tell them very honestly, I say, listen, I don't believe in channel checks. I think the channel checks mislead you. The correlation between historical results and historical channel checks, the correlation, if it was -1, it was great. At least I would have done the opposite. It's zero. It's basically zero in grand things. Otherwise, stocks would have not moved that much on results.
Yeah.
And I told them, let me give you a different answer. I will tell you, because I talk to so many investors, I'll give you the consensus view. I'll tell you what investors are looking for, and collectively, what is what's called the bogey, meaning the company guided for 28% growth, but investors are looking for 30% growth. So at least you know what the company needs to report for the stock to go up.
Yeah.
It's not 28. 28 is not the right number. Company, it's 30. That's where investors are. So I'll give you the bogey, number one. And number two, I'll give you my view. What do I think is happening? It's not based on channel checks. It's based on me talking to management. So I'll give you an example. One thing that I'm doing with investor relations, I really value investor relations because at the end of the day, they talk to investors all day long and they can summarize the information for me, as I said. The last day of the quarter before quiet period, I make a call with investor relations. And I ask them a simple question, summarize for me, please. What did management say since they reported the previous result until today, until the end of the quiet period? Management is always saying things. And once they say it publicly, it's great. And that gives me the understanding of what management is thinking a day before the quiet period. What changed in the tone since last time? What did they caution investors of? For example, I'll give you an example from last quarter. One of the companies told me, we guided you for gross margin to go down, and the street took gross margin up. Like, I want to highlight our guidance.
Yep.
That tells me that the street is wrong, that the gross margin is going to go down because management made a point. Investor relation made a point to tell me that the street is wrong versus their guidance. So that is the value I can bring to investors. I don't have a crystal ball to tell them how the quarter is, but I can tell them where expectations are and what my discussions are with management, where management is, and maybe point to any mismatch between these two.
Interesting.
We're in Israel now, in Tel Aviv. We have some Israeli companies that are traded outside of Israel on NASDAQ.
100 plus.
Yeah. So NASDAQ, New York Stock Exchange. I'm not going to talk about European stock exchanges, but say the headquarters are here, okay? Would you prefer, where do you think it's right for management? I know what I think. You'd probably agree with me.
I know what I think, yes.
So what will be, the IRO, would it make more sense for the IRO to be based in Israel next to management or based in the States, for example?
I have a very firm view on this. Some companies, Israeli companies, so I have the luxury of being Israeli, was born here, went to the army here, then went to the US to study. And in my career, I've covered many Israeli companies.
Mm-hmm.
Some companies are Israeli in nature, but they're based in the US.
Yeah.
Management, CEO, CFO, marketing sits in the US. They're American companies for all intents and purposes, and they need the IR to be next to them. So I've been covering Israeli companies for 30 years. I've been covering American companies, but I've been covering many Israeli companies for 30 years. Even today, I cover Amdocs and I cover Checkpoint and others. Historically, some companies were based in the US, Israeli companies based in the US, CEO, CFO, et cetera, in the US. And some companies are based in here, meaning the center of management, CEO, CFO sit here, center of management, maybe even sales and sales support, et cetera. The best thing for IR is to be close to information. Now, if the information, and I'll give you kind of a general answer, but if the information is really in the US, meaning you have the CEO and CFO and head of marketing all sitting in the same building as you are, sit next to them. If they're sitting in Israel, IR has to be knowledgeable. The worst thing that can happen is that management is saying one thing in one country and IR is saying another thing in another country, and then you have a conflict. That's one thing. Second thing, the worst thing that could happen is that IR is disconnected, meaning you talk to them and they don't understand what's going on and they don't have a clue of what's happening. So you want to add value? I don't care if the investor relation is Israeli, American, European, or Asian. It's not about who the person is.
Yeah.
It's about the information flow. I need them to sit right next to the information flow. I need them to be knowledgeable. I need them to interpret to me on time. So exactly when the events are happening, interpret to me what's happening, whether it's good news or bad news. And most importantly, I need them to educate me. So they have to be close to the source of information. And that's why it doesn't matter, it depends on where management is sitting, but you want the investor relation to be part of the financial office, the CFO office, part of the CEO office, and be the bridge between me, the sell-sider,
Yeah.
to management.
Yeah. And I
That's the
totally
bottom line.
agree. So I like your answer.
I'm in love with your answer. And I think maybe to add to that,
Yeah.
something we heard from Avivit and
Avivit Manek-Khalil,
yes,
the CEO of Oppenheimer, Israel.
that what they have heard from US-based IROs or American IROs, that they can speak with US investors, but they kind of miss the Israeli market.
Yeah.
Now, I think on average, 20% of the cap table, give or take, of an Israeli company traded on NASDAQ are Israeli institutionals. And an Israeli Hebrew-speaking IRO will serve them well. It will also serve well the US, while the US IRO will kind of miss this portion of the market, and that's also important.
Right. Also, when I want to also touch something you said, you mentioned it more, like you talked about it a little less, but you mentioned it. There's the CEO, there's the CFO, but then I think a good IRO or a good IR person will work also with sales, will work with the marketing team, will work with the biz dev team, even R&D, like to understand and
absolutely.
really know. Yeah. And then that's also like, that goes back again to being connected really to the business and
Absolutely.
being next to the people.
I'll give you an example. I cover now, so the past few months I've been covering a space that is called neoclouds. Neoclouds are companies, like there is a company that half Israeli called Nebius covers it, and they're doing it. And neoclouds are companies that are building data centers, they're buying GPUs, they're buying servers, and then they sell capacity to hyperscalers.
Yeah.
It's technically so difficult to understand it. You need to understand physics, you need to understand cooling, you need to understand power consumption, you need to understand real estate, you need to understand the economics of a GPU, unit economics, how much you sell it. You need to understand the economics of tokens and unit economics of. If the investor relation doesn't sit with the engineers, with sales, with sales engineering, with marketing, they will never be able to teach me.
Right.
Yeah.
Right.
This complicated area. So at the end of the day, that's why I talked about the flow of information. At the end of the day, we can generalize and say that investor relations need to be in the center of the flow of information. If they're in the center of the flow of information, then they're well equipped to do their job properly.
I agree.
100%. I want to ask you about IPOs. You said that you're involved in tens or hundreds of IPOs. There seems to be like maybe a written script that an IPO, the company is raising funds, valuation is very high. First year post IPO has maybe a similar pattern in a way. Because
Similar meaning stock goes down?
Goes down, there's the lockup period, you need to be prepared from an IRO or from the IR policy or strategy. How do you get prepared for that situation?
Yeah.
What would you advise the company? Because you see that happen all the time.
Yeah.
That the company goes public, very high valuation, then it goes down. It's like a baby is being born. It takes some time before they start walking independently, right? So maybe similarly to a new company that just joined the...
So don't forget that the investors are not blind to it. Meaning investors understand, for example, lock-up period is something technical.
Right.
You have insiders and management holding the stock for 6 months. There's a date that they're going to be able to sell. Investors understand it, and if they hold it, it means that they're willing to hold it through that period, because it happens to all the companies and it's always on the same day, meaning it's the 6 months after that is, right? So, but then you have other parts, which, there is, IPOs are so complicated because you have opposing forces in IPOs. The sponsors, which is the VC companies or the private equity companies, they want to push their direction. They want to maximize value. The founders want to maximize value. The CFO and the IR want to do the opposite. They want to provide targets that are achievable. Meaning if they think that this company is going to report 100, they want to guide to 90. Because at the end of the day, you need to beat and raise. So as an analyst being part of the IPO, I'm actually on the side of the IR. Meaning I want the numbers. The last thing I want to do is embarrassment. To me, forget management. To me, I don't want to put a buy-in rating, and I don't want to put estimates on the company, and then 6 months after to say, sorry, stock went down, or sorry, these numbers are below expectations. So while other parties are trying to maximize the numbers and maximize the value, I think that in my experience, investor relations understand that you need to give achievable targets. And as a result, they will always hedge, and they will always, their numbers, the expectations, or they will always be conservative with their assumptions to make sure that management team can beat the numbers. Now, there are always extreme cases of management teams that are influenced by third parties. Who cares? Sometimes the sponsors or the founders, etc., that will try to maximize value. But in most cases, what I've seen, everyone understands the game, and they understand that when you sit down with analysts and you provide estimates, because remember, this is a new company, analysts are relying on you, on your own internal estimates, and then they put their own judgment. So everyone understands that they understand the game. They understand that they need to put numbers that, at least, I always tell companies, what happens a year from now, who knows? But at least give me estimates and don't embarrass me for the next 4 quarters. Give me estimates that are low enough that with high certainty, with good certainty, that you can beat the numbers for 4 quarters. And then, a year from now is, it's too far out.
The beat and raise concept is a must. Absolutely.
I think that it's a must because that's the name of the game.
Yeah.
Wall Street wants in growth companies, I'm not talking about slow growth, right?
Yeah.
But in growth companies, I cover tech, so I am only exposed to tech. This is a growth space. In a growth area, you have to do better than what the street is looking for the stock to go up. Because the one thing that one more sentence is, because technology companies don't trade on valuation. That's the whole thing. Technology companies trade on momentum. You have to be better than expectations for the stock to go up. That's the name of the game.
Do you see, again, you have a very, a lot of experience. Do you see a difference between companies that have, for example, a team that is IPOing for the first time versus teams?
Oh, absolutely.
Yeah.
I've done an IPO of a company once, and I felt almost like this little kid that says, hey, the emperor has no clothes. It's like, I told him, how did you gave me 30% growth, 30% growth, 30% growth. How do you get to this number? And I realized that he just
pressed an Excel.
Pressed the 30 on the Excel. Like there's no model below that. And I told him, if you grew 23% before, why are you going to accelerate the 30?
And when you're becoming bigger.
Right.
So
and I said, it's the law of big numbers. When you become bigger, you grow slower, even if you grow the same amount of dollars, right? And I think it was one of the first times that I came out with a sell rating on the stock after an IPO.
Ooh.
Because I said, your numbers are not achievable. And by the way, everything that I scripted kind of happened. They could not hit their numbers. Bottom line is when you were, and he was very inexperienced. Bottom line is when you work with someone who had done it before, and sometimes management teams, not all the managers, for many managers, it's the first round. Yeah. It's a new founder, first round. That's not a negative. The negative part is that when they don't understand, they need to have someone experienced next to them.
So like an IR.
IR
example.
or CFO or both that have done it before. They understand the Wall Street game. They understand how to set expectations. They understand how to manage expectations over time. If they understand the game where what I said before, that stocks, technology stocks trade on momentum, not on valuation, they would understand that they need to manage expectations pretty carefully. And that's not a game for someone who's doing it the first time. It's you need to have some experience in doing that.
Yeah. And then also, if I like going back to previous episodes, so the one with Rami from Tabula, he gave an example, and we talked about how they weren't an experienced team, but they understood, like during the getting ready, that they need someone experienced. So yeah,
Daphna,
yes, Rami.
we're now moving to the part before the end.
Okay.
Which is the rapid fire questions.
Okay.
So I ask you a short question, give me a short answer, very quickly,
One word.
like hummus or trina,
Yes.
this kind of thing.
Or shawarma.
Most underrated quality in an analyst.
The ability to say the right thing and not be afraid of the reaction of management.
One habit that you've gained that you think made you the great analyst that you are.
I grew up in Bat Yam. I was never afraid to ask the right question. And I think right from the beginning, from the very first day in 1998 when I started, I decided that the what's missing in Wall Street, the way I saw it, is the ability to stand with no fear and just ask the right question.
So be brave.
Be brave. Absolutely. By the way, I just want to say one thing. Today, we're talking about 30 years after. When you read what people write about me, kind of in the way when they write reviews of my work, they say always asking the right questions.
Numbers or narrative?
Narrative, 100%. Supported by numbers, but narrative is more important.
The worst answer management can give.
The management that they think I want to hear.
Company you admire, not because of their performance, but because of the way they communicate in the street.
Cisco, hands down.
Cisco.
Yes. Because I tell you why, because they understood that they need to bring an investor relations that really understands the game. They took a sell-side analyst, made him an investor relations. Since then, suddenly everything is clear. It's a giant company, $60 billion of revenues a year, and he's able to synthesize a giant company into a few big messages and give us the numbers to support it. This ability to broadcast the right message and connect it to the numbers and basically teach Wall Street, teach investors, teach sell side, what are the right things in the company, that was missing before. Look at what happened to the stock since he joined the company.
What's his name?
Sami Badri.
Now, you need to give the right answer.
Yeah.
Research report or podcast?
Research report, because listen, otherwise I would have told you that my entire work in the last 30 years is worthless.
Coffee or Excel?
I love Excel. Excel talks to me. You know that? When I open Excel and look at the numbers, it talks to me. I hear my name saying, Tal, this is what's happening here. Coffee is next to the Excel to help me,
to support you.
Yeah, to support me while I'm looking at the numbers.
I'm awake. Yeah.
Jazz or CNBC?
Jazz, 100%. Jazz before life.
Ooh. That's it for rapid fire?
I have another one.
You have another one?
Right now.
Okay, go ahead.
New York Knicks or Apol Bat Yam?
So, I am not a big sports fan. Whenever they tell me the Yankees did this and that, I told them, okay, stop for a second. Is the Yankees baseball or football? So I'm at that level.
Okay.
But you ask me about Hapoel Bat Yam. Who cares about Hapoel Bat Yam? I've never been it. Hapoel Tel Aviv. It's a different issue.
Basketball or football?
Basketball. My brother-in-law was the captain of Hapoel Tel Aviv for many years.
Okay.
And his name is Shimon Amsalem. So I am, yes. So I am in my veins ingrained Hapoel Tel Aviv.
So it's not by coincidence, or yes, it happened that you're just after Ofer Yanai, the owner of...
Yes.
Okay.
Wow.
He's the manager today. My brother-in-law is the manager of Hapoel Tel Aviv. Yeah.
So you know Lotan Amsalem as well.
Yeah, of course. He's my
So
nephew.
we are coming to an end, and before that, we have another like
The
the
golden
ending corner is like the golden tea, named after
Daphna Golden.
Daphna
Yes.
Golden. So Tal, after being an analyst for 30 years, imagine a young analyst that listens to this wonderful podcast, or like an IR professional.
Yeah.
What is the advice that you could give them at the beginning of their career?
IR is a different thing. I'll talk to analysts. The number one is don't be afraid.
Mhm.
Don't be afraid. Say exactly what you think. Because at the end of the day, yes, at the beginning you might make enemies with companies, with IRs, because you'll insist on certain things. But if you're right, the world will admire you.
Mhm.
Be honest with yourself. Be honest with your investors. That's the only thing that will keep your career running for 30 years.
Yeah.
Being nice to management teams will bring you maybe some friendship for a short period of time, because you'll be used by management team to just always communicate what they want to communicate.
Yeah.
But people that pay you are the investors, not the management teams. And that's why you have to always do the right thing for the investors. That's the number one advice. And everything else is coming. It's a derivative of that.
Thank you, Tal.
Thank you.
We really enjoyed this one.
Thank you so much.
And thank you, Daphna.
Thank you, Rami.
What do you want to say?
Yeah, I want to say...
Ending words?
Yeah.
Go ahead.
Okay. So thank you to everyone that listened to Investors in Relations, משקיעים בקשר. We want feedback.
Of course.
Right?
Questions if you have.
Yeah.
You can ask in the
Yeah.
future sessions.
Right. And as we said before, we always like take the feedback and we try to implement it in the
Exactly.
upcoming episodes. So thank you. And
Thank you,
Tal.
and shalom.
Thank you so much.
Thank you, NASDAQ, for supporting Investors and Relations, משקיעים בקשר.